Follow the money. It always leads somewhere they didn't want you to look.
In 2026, private equity firms globally manage approximately $7 trillion in assets, a figure that has steadily grown over the past decade. These firms operate by pooling investor capital to acquire stakes in private companies, with the aim of improving performance and eventually selling them at a profit. However, the underlying model relies heavily on the ability to exit these investments profitably. Recently, a significant issue has surfaced. The exits are stalling. In 2025, the value of private equity-backed exits fell by nearly 30% from the previous year, according to PitchBook data. This slowdown is linked to a series of factors, including rising interest rates and market volatility, which have made potential buyers more cautious. As a result, private equity firms are finding it increasingly difficult to sell their holdings, leaving vast amounts of capital tied up in illiquid assets. A critical component of private equity's allure is its promise of above-market returns. Historically, these firms have touted annual returns in the range of 15% to 20%, significantly outperforming public market indices like the S&P 500. However, recent data suggests a sharp decline in performance. The Cambridge Associates LLC US Private Equity Index reported an average annual return of just 8.5% over the past 5 years, barely surpassing the broader market. This underperformance raises questions about the sustainability of the private equity model, particularly as firms face pressure to meet return expectations amid challenging economic conditions. Moreover, private equity's impact extends beyond the firms themselves. Institutional investors, including pension funds, university endowments, and sovereign wealth funds, are heavily invested in private equity. These entities rely on the outsized returns promised by private equity to meet their own financial obligations. As the ability to exit investment stalls, so too does the flow of returns to these investors, potentially affecting the financial health of millions of individuals worldwide. For example, the California Public Employees Retirement System, CalPERS, one of the largest pension funds in the United States, has over 10% of its portfolio allocated to private equity. Any significant downturn in private equity could have ripple effects on beneficiaries relying on these funds for their retirement. Adding to the complexity, some private equity firms have begun to write down the value of their holdings. This process involves reducing the recorded value of an asset to reflect its current market value, acknowledging that the asset may not fetch the anticipated price if sold today. These write-downs are a stark acknowledgement of the challenges facing the industry. For instance, in 2024, several prominent firms, including Blackstone and KKR, announced write-downs totaling billions of dollars, signaling a broader trend of re-evaluating portfolio values. As the private equity industry grapples with these challenges, a critical question looms. What happens when an entire asset class, premised on trust and historical success, confronts a market environment where liquidity and valuations are no longer guaranteed? The private equity conundrum is compounded by the evolving regulatory landscape. Governments worldwide are increasingly scrutinizing these firms, concerned about systemic risks and transparency. The European Union, for instance, has been tightening regulations through directives like the Alternative Investment Fund Managers Directive, which imposes stringent reporting and operational requirements. This regulatory pressure aims to mitigate potential risks that could arise from the vast sums managed by private equity firms. But it also adds operational burdens that could further strain their ability to deliver high returns. In the United States, the Securities and Exchange Commission, or SEC, has proposed new rules to enhance transparency in private equity dealings. These rules would require firms to provide more detailed disclosures about fees, expenses, and fund performance. Such measures are designed to protect investors, but may inadvertently increase the administrative load on private equity firms, potentially impacting their operational efficiency and profitability. The interplay between private equity's operational model and the broader economic environment cannot be overlooked. The industry's reliance on debt to finance acquisitions is particularly noteworthy. As interest rates rise, the cost of servicing this debt increases, squeezing margins. This is especially true for leveraged buyouts, where firms use significant borrowing to purchase companies. With the Federal Reserve raising interest rates to combat inflation, the cost of borrowing has risen, affecting the profitability of these highly leveraged deals. Moreover, geopolitical tensions and global economic uncertainty further complicate the landscape. The ongoing trade disputes and supply chain disruptions have introduced additional volatility to the markets. This uncertainty makes it challenging for private equity firms to accurately project future earnings of their portfolio companies, complicating exit strategies. The ripple effects of these challenges extend into the real economy. As private equity firms struggle to exit investments, their portfolio companies often face prolonged periods of uncertainty. This can lead to reduced capital expenditures, delayed growth initiatives, and in some cases, workforce reductions. The broader economic implications are significant, as these companies collectively employ millions of people globally. Despite these challenges, some private equity firms are adapting by exploring alternative strategies. There is a growing interest in the secondary market, where existing stakes in private equity funds are bought and sold. This market provides liquidity for investors seeking to exit their positions without waiting for a traditional exit event. Additionally, some firms are pivoting towards long-hold strategies, where the emphasis shifts from short-term gains to sustainable long-term value creation. As the private equity landscape continues to evolve, stakeholders must confront the possibility that the traditional model may need to adapt to survive. The industry faces a critical juncture, where innovation and adaptation could determine its future trajectory. The question remains, can private equity successfully navigate these turbulent waters? Or will the pressures of a shifting economic and regulatory environment prove insurmountable? As private equity firms confront these formidable challenges, the broader financial ecosystem continues to watch closely. The potential impact of the industry's current struggles extends far beyond the firms themselves, touching various sectors and stakeholders. The situation presents a multifaceted dilemma that encompasses not only financial performance, but also regulatory scrutiny, market dynamics, and the very nature of investment strategies. Institutional investors, who have long been key players in private equity, are now faced with tough decisions. As returns falter and exits become protracted, these investors must evaluate the risk-reward balance of maintaining their allocations in private equity funds. Pension funds, university endowments, and sovereign wealth funds may need to reconsider their exposure levels, potentially shifting resources to other asset classes that promise more stable returns. The decisions made by these large investors could have cascading effects across the global financial landscape. Meanwhile, private equity firms are compelled to innovate and adapt. The exploration of secondary markets and long-hold strategies represents an attempt to diversify and stabilize their investment approaches. However, these strategies also come with their own sets of challenges and uncertainties. The effectiveness of these adaptations in mitigating the current issues remains to be seen. Firms that can successfully navigate these strategic shifts might secure their positions in a rapidly changing environment, while those unable to adapt may face declining relevance or even collapse. On the regulatory front, the push for greater transparency and accountability continues to gain momentum. Governments and regulatory bodies are increasingly focused on ensuring that private equity operations do not pose systemic risks to the financial system. This regulatory pressure, while aimed at protecting investors, could also reshape the way private equity firms operate, potentially leading to a more transparent and equitable industry. However, the balance between regulation and operational efficiency remains delicate, with the potential for unintended consequences. The economic and geopolitical landscape further complicates the picture. Rising interest rates, inflationary pressures, and geopolitical tensions contribute to an environment of uncertainty and volatility. These factors challenge private equity firms' ability to forecast and strategize effectively, impacting their decision-making processes and long-term planning. As the private equity industry stands at this crossroads, a fundamental question emerges. Can it reinvent itself to thrive in a world where the old assumptions no longer hold? The answer to this question will not only determine the fate of the private equity sector, but could also have significant implications for the broader financial markets and the global economy. As investors, regulators, and market participants watch closely, the unfolding developments in private equity could serve as a litmus test for the resilience and adaptability of modern financial systems in the face of change. Ultimately, the resolution of these challenges will shape the future of private equity. Will the industry find new pathways to deliver the returns that investors have come to expect? Or will the pressures of a shifting economic landscape prove too great? As the world watches, the private equity industry must confront these uncertainties and determine its path forward.